Good afternoon. As I sit here, it's Valentine's Day and Friday afternoon before a holiday weekend. So I thought it was a perfect time to talk about inflation. Really though, I hope everyone has a happy Valentine's Day. However, before you head to the store to grab chocolates and a card, take a minute to watch this short video on January's inflation number, learn how it may be impacting your portfolio, and why all eyes remain firmly fixed on this normally benign data point. I'm Dave Wagner, CEO and CIO of Tidecrest Wealth Management. Let's get into it. The annual headline inflation rate in the U.S. edged up to 3% in January, compared to 2.9% in December, posting the highest reading since June of 2024. It's indicating stalled progress in curbing inflation. This increase was driven by higher costs in shelter, food, energy sectors. Notably, as you probably heard, egg prices surged by 15%, contributing significantly to the rise in food prices. Gas prices also increased about 2% in the month. So why does inflation matter to investors? Inflation, the rate at which the general level of prices for goods and services rises, has a significant impact on the stock market. When inflation is high, the purchasing power of consumers decreases. Corporate profit margins may shrink, and investor confidence can waver. One of the biggest factors influencing the stock market during inflationary periods is the Federal Reserve's response, particularly those through adjustments to interest rates. The Federal Reserve, the central bank of the U.S., uses monetary policy tools to manage inflation. One of the primary methods is raising or lowering federal funds rates, which can affect borrowing costs across the economy. When inflation rises above the Fed's target, right now it's about 2%, the Fed may increase interest rates to slow economic activity. Recently, inflationary pressures have influenced the Federal Reserve's monetary policy stance, specifically when the Fed announced in December that rate cuts may move at a meaningfully slower pace than the market was anticipating. Stock market sectors respond differently to inflation and rate hikes. Growth stocks, such as technology companies, tend to be impacted more significantly by interest rates because their valuations are based on future earnings further out into the future, which are discounted more heavily with higher interest rates. On the other hand, value stocks, such as those in the energy or financial sectors, might not be as impacted, as they are expected to generate profits over a shorter time period. Investor sentiment also plays a crucial role. When inflation is high and the Federal Reserve signals aggressive rate hikes, investors may shift their money away from stocks into safer assets like bonds, which become more attractive as yields rise. The movement of capital can lead to stock market volatility and corrections. In summary, inflation creates uncertainty in the stock market by raising costs, pressuring profit margins, and prompting the Federal Reserve to take actions that can influence interest rates. Due to this relationship, inflation will remain top of mind into the foreseeable future. We'll be back to share the news about the February inflation numbers when they're released next month. If you have any questions about how inflation may impact your portfolio, please don't hesitate to reach out. For more content like this, please subscribe to our channel, visit our website, or click on the link below for more information. We look forward to hearing from you. And of course, happy Valentine's Day.